Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. Today's agenda, I'll go through the market update. Joe's going to talk on a couple of things, AAII survey, and I think he's going to talk about some sectors too. And then Shawn's going to go through and update the earnings trades to show you how those are doing. So that's the agenda today. Just a reminder, next week, Ashok will be tuning in and speaking. So we all have that to look forward to. So let's get started. Okay, overall market-wise, last week we still had these eights. SPX went from 3 to 4, so everything's showing bearish right now. Green pie obviously shrunk some. Had a pretty good move in the state eights, outside of yesterday. So we'll go through and analyze each one of those. So you can see, last week we were about 40, 43. So now we're up to like 47 kind of area. We kind of topped out last time around 49. Last move, the one before that 43. So, it could be, but if we start getting movement here on the bullish side, that could be, a move upward. Hard to say, just off of that. We're getting no new highs, getting little spikes here. You can see 400, 500, and then in the new lows, but nothing super significant. I guess 500 is pretty pretty big move. But we're not seeing, it's kind of quieted down since all these big spikes in the past year. So that could be a good sign. We'd like, bullish wise, we'd like to start seeing highs above the lows with some, some good spikes, like this, 700, 500. But we're not seeing those. Those are kind of flatlining and we're still getting new lows. So let's take a look at the bullish bearish.
Alexa, turn off the music.
What's that?
Sorry. I'll mute. I just got in.
I got you. No problem, Lee. I didn't hear any music. So, we moved up slightly from last week, 2% higher. What I showed you before, we can kind of go back and forth between these, crossing over and until we get some kind of significant move. It looks like it's kind of leveling out here, which could mean bullish. I'm just, it's a very difficult market and to be honest, I'm not getting a ton out of the current state percentages. We're in the middle of between an overbought. We're not even close to an overbought, but we're not at an oversold either. We're oversold 30%. We're still 11% above that. So we're pretty much right in the middle of a range, which pretty much explains, range bound type stuff, which is what we're seeing on all the charts. So that's kind of down low on market pulse. Let's look at SPX. So I went into 4. Last week we were in 3. Pretty much went sideways. 4. We got a nice spike yesterday. I think we're up. I haven't looked. We're up a little today. Just obviously not a typical pattern already. It spiked up on the first day. That could be an indicator this is like a near-term bottom. Hard to say. I think, our big thing is our resistance levels to the top side. We got to watch. So let's look at the actual chart. So, sorry, So you get the SMAs here in the green, and then I drew the lines. So that's our key levels. So this is our resistance here, 4,600. And then that's our support, 4,200 on SPX. So we're kind of creeping up here. Right near that, I think that's a 200 SMA. So, kind of watch to see if that's going to be resistance. But I mean, the critical levels is this 4,600, whether we get over that or not. So we've been range bound for, almost the whole year. It's been 3 months. That's the last when basically the range started. So until until we get any kind of breakouts, either way, up or down, sustained holds above it, not 2 days, not 1 day, not 1 day. Until then, I would still kind of expect, range bound. And since we're getting near, I think we're currently at, 4478. So we're getting up right near this 200-day SMA. So I'd kind of watch that. It looks like down here, this 50-day provided pretty good support. So, that's definitely helps bullish wise. We don't want that to turn into resistance, which, pretty much is with the Russell, but we're getting support here. So I think that's key. So, what's at 200? And, obviously this is the most critical, 46. Yeah, if we can stay above that and hold, then it'd be very bullish. But, since we are range bound, we are, kind of getting near the top of the range. So, I'd just be careful on that. As far as the Russell, so state 8, where were we last week? We were in 7. And it was not performing, pretty much sideways. We had a little dip, went into 8, and it's pretty much sideways again. The key levels for the Russell are 2,100 and 1,900. I'll pull up the chart there. So this 2,100 here, this was our support on that like year-long channel. So now this has turned into resistance. So this is your key level. If we get a bullish breakout, stay above it for more than a couple days. So that's the key on that 2,100. I think something to watch, right? Our support here is 1,900. You can see, obviously, anytime it touched 1,900, it jumps. So I mean, that seems bullish to me, that it's like jumping significantly anytime it touches that. But we'll have to wait and see. I think one thing to kind of follow right now is you can see this 50-day has been a problem. It's the top bar here. It had problems here, kind of like in here. It got over a little bit, and now it's right on that 50. So 2030. So I think that's something to watch. It's obviously, very far away from, this is the 200. But I think, this is something to watch, see if we can close above 2030. And then, next up, would be that 2,100. And that's, obviously very important level. So they're both kind of creeping up higher. But, as far as, everything we see here, we're still range bound. And, as we get near those levels, until we break those, discontinue any kind of trading based off of that, we get near lows, we could find support. At some point this is going to break, but, as we saw with Russell before, let me pull it out long term. These things can go on for quite some time. This was February. I guess basically we identified this in March, kind of April timeframe. And it went all the way till basically here in January. So it's almost a year. It was kind of channeling, and we had one false breakout there. You know, and we had a little breakout here, false breakout. So Russell's tricky, but you know, these things can channel for a long time. And you know, I think you know the keys are just kind of you know keeping on these key levels. And if this 50 is becomes a real, you know, it's been a problem, you know, since beginning of the year. So you know, if it can if it keeps staying below that 50, then it's going to be a problem. But you can see the 50 right here is kind of flattened out. Um, so that could be a good sign, you know, that it's flattening out. You know, we went through a bunch of the long-term charts and, you know, Russell, like XLY, they've moved so much. They've had big moves down, and it could be a bottoming area. But you know, the problem is like SPX is like just crossing on those charts. So I'll show the IWM first here. Just talking long-term charts. So you can see this one cross basically January, been kind of flat. So we just had to watch down here. You know, if this stochastics at this point like flat lines and doesn't move up, normally you can see we get these bounces here. So if this thing flat lines, and then it can get ugly. But typically it does bounce. You know, you get these nice like V's. So that would be a big thing to watch. If you see this thing turn up, then that'd definitely be very bullish. If not, then I'd expect, you know, sideways movement and possible downward trajectories. SPY's totally different. And we went through all these different ETFs before. But you know, this one's just crossing. So you can see here, it's kind of, the stochastic is a little flattening. So, you know, if that turns up, you know, like here, I mean, it can turn up in the 60s, it can turn up in 40s and the 20s, whatever. So, you know, if that thing actually turns up and holds, obviously very bullish. But, you know, right now, as we see, it's still like, you know, trending downward, and, you know, we're getting these bump ups, you know, pretty big days, and then, you know, it'll be down for a while. So, so just something to keep your eye on with that. So as far as the Fed, you know, we're only a couple weeks out, pretty much certainty that we're getting 50 points here. You can see, I mean, we were talking months ago, this was like an outside shot. So now it's pretty much a certainty we're getting a 50-point hike in May and also in June. So just so you know, along with that, you know, we're getting a lot of this this 10-year. This 10-year is a key level to watch. Obviously, you know, we talked about these charts. This one's very bullish. This is kind of like the, just a reminder, you know, I don't know when I went to those ETFs. That was probably like 2 or 3 weeks ago, but I don't know if any of you guys have been following them, but they've all done pretty well. I think it was XLE, XLP, XLRE, and XLU as our only bullish sectors. You know, the other ones are neutral, and then we saw, you know, quite a few bearish ones, but those ones have all done pretty well. But you can see here, I mean, the separation on MACD, it's just such a bullish move right now. Yeah, that, you know, this, you know, if you're going to trade this, you can't really trade, you know, the treasuries outside of like commodities markets, but, you know, you can always, they have TLT. So that's the 20+ year treasury. So in case you aren't aware, like the bonds are affected, you know, like it's called a duration risk. So the further out the maturity, the more it reacts to interest rate moves. So this one would probably be one of the most active against, you know, higher and higher interest rates. So, and I did promise you I'll get to that chart on the importance of the 10-year, and I think it corresponds to, like, I was always saying like 2.5. I think that's the Fed fund rate at 2.5, and then the Treasury, the 10-year, I think at right around between 4 and 5 turns negative for equity. So I'll get that chart. I have it in the office. I'm not in the office today, but I'm going in tomorrow, so I'll send that out in an email so everyone can have that.
Hey, Josh. Hey,
yeah.
Josh. This is Dave. Can I interrupt you just for a second while you're talking about the 10-year?
Yeah.
I was reading an article from one of the banks that were saying now's the time to go long on the 10-year bond, because they said that it's high right now and they expected it to fall by the end of the year. And I was trying to figure out how that works, actually, because it's kind of an inverse relationship there in the first place, but how that flies in the face of raising rates. If we're going to do a 50 basis point rate in the next 2 Fed meetings, I don't understand how that quite works out to be buying the long 10-year bond right now, or 10-year Treasury. So anyway, I was curious about that. And I'm thinking, and in the same article or one right next to it, I read where several of the banks are selling bonds, selling debt. And this included, I think, JP Morgan and Bank of America. And it's like, why are even banks allowed to? I've been surprised banks are allowed to sell debt when they're in the business of lending money.
Oh yeah, they have their own bonds. Yeah, they're always allowed to do that.
Oh, okay. Well,
Yeah.
sorry.
But as far as the 10-year going down, I mean, every conceivable force right now is against the 10-year going down. So unless they know something, unless there's another pandemic where they're going to drop rates to 0 and start buying assets again, then everything else is pushing it higher. So I don't have any inside knowledge like they do, but if they're raising the actual Fed funds rate, they're no longer buying all the assets, all these bonds. So the bid is now gone. So it's going to be open to market forces. So and inflation's clicking between 8 and 12%. Just a side note, like the eggs I normally buy have doubled in price at this point, since I started checking. So that's not 8% inflation. That's like that's a lot more. That's like it doubled in price. Like it's probably been like a year. So and it doesn't, there's no real signs that it's getting better. I mean, there's articles about fertilizer not being delivered to farmers. There's bird flu where they've like called like millions of chickens, like crazy stuff. So I just don't feel inflation going away anytime soon. But unless they have inside knowledge that I don't, everything that I see points to higher and higher Treasury rates. So, well, that was it for my wrap up there. Thanks, Dave. Any other questions or comments? Dissenting opinions? Yeah.
No, look, Josh, it's Lee. Could
Hey,
you
Lee.
go back to your SPX chart that you had up just a few minutes ago? Okay, and we're saying it's range bound. The same, I think, applies for the Russell.
Yeah.
Why wouldn't you, on a real short-term basis, or tell me the negative of thinking about an iron butterfly here on a short-term basis, maybe a week or something? If it's range bound, we don't expect it to get out past whatever the range is, the wings.
Yeah.
What's the negative of doing something like that?
Well, the short term, I mean, you know, it's all about how you set it up, right? So like if it's
Yeah.
short term and you like sell the 440 and you're buying 450 and 430, you know, if it gets up here to 455 in the next week, you know, you're out of luck, right? So you'd probably
Yeah.
want to do it longer term,
Right.
you know, that type of thing. Or, you know, or you can wait till like, okay, it's up high, I expect it to come back down. You know, if it's up here, then you can do one centered on 440, you know, give it, you know, some time to get back because, you know, they can hang up there. So, you know, it's not like a perfect science, but yeah, there's nothing wrong with that, doing stuff like that.
Okay.
I just, you know, always be careful with that, like short-term stuff. And, you know, you can see, I mean,
Yeah.
who expected this like big move yesterday or these big, I didn't, you know, it was on that bottom level, but I didn't expect it to basically run to the top, you know, in like a couple, like, was that like 2 weeks? Like I don't know
Sure.
anyone that knew that, you know, so,
Yeah.
yeah, so I just give yourself, you know, some leeway.
Okay. Thank you.
Yeah. All right. Thanks, Lee. Anyone else? Questions or comments? Feel free. All right.
Actually, I'll throw something out there just
Yeah, shoot,
for
Dave.
interest. This is a sort of a valuation thought, or I guess thought. I was, you know, I don't know. I guess everybody's probably heard that Netflix was down like significantly after being down significantly,
Yeah.
and it was interesting to hear all of the reaction pundits, analysts, you know, come in and it's like, well, how did we miss all this, you know, kind of thing. And one thing I wanted to, that I kind of was drawing out of listening to a few of those is that most of the analysts, I guess, use this discounted cash flow basis for making their predictions, which is what I'm putting in my mind is like a wild wag guess at whatever the cash flow in the future might be
Right.
compared to what the cash flow is today and the multiple that they have. And I've heard, you know, a couple of them say, yeah, well, you know, now we're bringing down our future estimates. Well, it was just a guess in the first place. So, you know, that I guess my bottom line here is it's like I pay little attention to analysts and what they're guessing at in some of the industry groups that I follow because I think they're just going on, you know, trends and you know that's basically what they do. They follow the trend. That's why when you're in an uptrend, they're just feeding on raising the guess to match the prediction that they want to make, raising
Right.
the guess that they're making in the future. So as long as it's going up, you're going to continue going up until it hits a breaking point, just like Netflix did today. Now the trend got broken, and it's like, okay, now since they had no idea what the guess was in the future, I guess my point is, well, I'm not going to listen to them anymore, or you know, I haven't listened to them a whole lot, but it's like I don't know that free cash flow method for trying to predict is worth two beans. I'd rather follow the Delphian other trades than that. So any comment on how well, I don't know, does that make sense what I was thinking of why the trends, you know, keep going until they get overshoot by so much, then they have the guesswork just falls apart?
Well, I think it's just like a matter of time. They can only like bluff you for so long. I mean, like look at like PayPal, like what do they do? Yeah, like that one's like crashed. Like they do peer-to-peer like money transfers. Like I've done it, like I've used it. It's like it cost me like 50 cents or something. I'm like, that's not like I mean, and there's like Zelle and there's all these other same like type of payment programs. So unless they have something spectacular coming out, I mean, they're just in competition for, 50-cent transfers. Like, it's nonsense, like that they were like, you know, valued so high. Netflix has a lot more than that, but I think, there's a lot more companies out there streaming. I mean, you can go online and there's like, you can get any movie you ever want, like on pirated sites. So like, if inflation's hurting people, they're paying more for gas. Their credit card bills are going higher. What's the first thing you cut? Your extras like Netflix. So that may just be like the canary in the coal mine. I don't know. But yeah,
I was just I want to apply that forward to one other stock that I watch a lot, because in the semiconductor group there's Nvidia, for example. Yeah, I kind of look at that as kind of like the Netflix of that industry group, where it's kind of like a one trick pony kind of thing, where they don't have too much. They're kind of a pure play, and it's been going up and up and up because for the same ratcheting mechanism I just mentioned with the analysts, doing nothing but bidding up because the price has been going up. So they had to increase their gets out in the future to match the rate, even though it doesn't make sense. So I'm watching that one. I expect almost the same thing to happen. We'll see.
But you don't know when. You got to ride it on the way up. So let's, you don't know when they're going to turn on it. I'm sure it's like you can see here, like in December, things got ugly for Netflix, right? January, real bad. But you can see things like turning over here, and it just got bad. So let's look at Nvidia. It's
I see a similar setup. I'm just guessing.
everything's a similar setup except for those ones that I showed you. Everything looks like this, except for those other ones like XLE, XLP, XLU. I mean, everything else looks like this,
right?
which can get real ugly, as you can see. Like a crossover, it can get real ugly. Ugly. Right.
All right. Well, thanks. Sorry for butting in there, but I just thought that was, since Netflix was in the news always today, and it's like, it was sort of like going to happen sooner or later. It's just crazy that it went down so much after being down so much. I think that's what caught everybody.
Yeah.
Aren't companies supposed to pre-warn when this kind of thing happens? I thought there was some responsibility for doing that.
Yeah, well, I think Ashok's bullish on it now after this one. So, I mean, it hadn't been down here since 18. I think Ashok will probably talk about this next week, but give it a few days and it's still got a lot of value. I mean, it's got a great programming. I don't know.
Yeah, well, thanks for listening. Sorry for the interruption.
It's always a pleasure, Dave. All right. Well, Joe, you want to go next?
Sure, Josh.
Okay.
Can I maybe just grab the screen?
Yep, sure. I stopped sharing there.
Okay, thank you. Let's see. Can everybody see that? Or not yet?
Not yet.
Not yet. Okay, hold on a sec. I'm on share screen. Where the hell'd you go? There we go. Boom. Okay.
Yeah.
So hi,
Gotcha.
everybody. Yep. Howdy, everybody. I am, I said before, I'm not a big excuse person, for why the markets move and stocks in particular, but I just did want to, this caught my attention. We've referenced it in the past, the AAII survey that comes out every Thursday morning about 9 o'clock. I was just taken back by, the numbers this past week. And as Josh said earlier, thought yesterday's rally kind of came out of nowhere. And, you know, when I saw this, I was, you know, frankly, just blown away that the numbers had changed so much over the course of a week. I mean, you know, a combination of more bearish, fewer bullish, the magnitude of those moves over the course of the week, and, you know, over the course of a number of months, the numbers have just, you know, kept heading in this direction. But I don't know whether you do pay attention to this thing. Generally, it's kind of slow moving, but you know, it just seemed awful extreme. So I just wanted to point that out again. There was an article actually here that we can throw into the share file that offers, you know, some historical perspective. And that was a good old AAII. And then just, you know, Josh does a great job talking about the different sectors. And I just wanted to, you know, touch on two at a very high level. I mean, you know, we're struggling obviously from a sentiment standpoint. I think Sadir's mentioned, you know, just IYT, the transports. And I just wanted to bring up the charts. Just, I think the transports, the financials, they're always damn important, you know, with regards to the overall health of the market. This is a long-term chart of the IYT. So, you know, you can see it's a kind of sideways, you know, to a point over the last year or so, you know, shrinking that down. I mean, been volatile. You know, you got, you know, maybe a slight negative parallel channel, you know, in this particular chart. Really fell out of bed over an 8-day period, you know, end of March. As Josh had said, you know, we had that early March low in most of the indexes and then ran up through the 29th or 30th of the month. And then the transports got totally whacked again, but have lifted a bit. So I would just say something to keep an eye on. We do not have, you know, this in the Delphian platform yet, but as we incorporate SIBO data on a 20-minute delayed basis, hopefully sooner rather than later, we'll be able to track that. And then financials, I just wanted to, you know, take a peek at the XL left. It's obviously not a volatile index. It's not the best index from a modeling standpoint as well, but you know, just something to keep in mind. You know, that February low, the recent March low was considerably higher, so you know, constructive to have the higher low. Here's, you know, we had a good run, but going back a ways, you know, after the election, we get into a state one, it ran a long way. It was kind of a whipsawing back and forth inside of state modeling, you know, over the last solid 8 months. But, you know, I would just say something to keep an eye on. We've had a couple good days here. You got a higher low versus February. There are just a couple indexes. I try to keep an eye on the transports and the financials. So that's all, Josh. Just wanted to touch on that.
All right, thanks, Joe. Yeah, it was, the AAI really jumped out. Thanks for sharing that. So, anyone have questions on that? Yeah. All right, well, let's get Mr. Shawn rolling here. You there, Shawn?
I'm here. How's it
All
going?
right.
Hello, everybody.
You
All right,
got the
I'll share
mic.
my screen. All right, cool. Let me share my screen since I always forget to do that. But what I wanted to show everyone was, you know, like we talked about last week and so on, just trying to, you know, make sure I'm keeping up with the virtual portfolio as best as possible regarding, you know, the trades that we've been doing for the earnings for the Q1 2022 earnings plan. So I have all of the trades entered in here, but I do want to have this portfolio up first, which is the major one that has a lot of the symbols in there for this particular plan. And it's our, you know, bullish pre-runners. And these are all the confirmed trades. So I talked about it last week, just having two separate portfolios, one for confirmed and then one portfolio for the estimated ones. Sorry, my phone just went off for some reason, or my watch, excuse me. So, you know, so the move yesterday, you know, we had a decent move yesterday, which has been talked about. And that move yesterday helped these portfolios substantially because obviously we're talking about the majority of them being bullish trades. So, you know, I think I had 3 positions as of the day before yesterday that were closed. And then coming into today from yesterday's move, you know, 4 more positions were closed. So that, again, helped the portfolio. And then a couple others that we talked about last week, you know, Intel and American Express both have earnings. You know, American Express has earnings coming out on the 22nd, I think, before the market opens. So that one I'll have to be out of that trade for tracking purposes, you know, prior to the close tomorrow. And then next week we have Intel. But you can see these positions themselves were down, you know, I think more than 50%, you know, prior to yesterday's move. So yesterday's move helped these positions, you know, gain some of that money back. I think Intel's up maybe 1% today, and American Express is probably up almost 1% as well. Some of the other positions that are down, Bank of America, I think is in here maybe, or maybe it's in a different one. But there's a couple other ones, those banking sectors, which, you know, are up a little bit today as well. So some of those are getting some pretty good moves in the portfolios. But really we can see, you know, again, we started these portfolios with $100,000, which, you know, I think is a little too much, you know, for what we're trying to track, but I wanted to make sure and keep it consistent. So I did that. So based off of the $100,000, we can see that the return on capital is, you know, 0.61% currently. Excuse me. And I mentioned it last week as well that, you know, if the starting capital was lower or a more reasonable amount, then obviously that return on capital increasing. So I put it in an Excel formula or an Excel sheet to kind of display that information. And anybody just jump in if this is wrong. This is the way I think the best way to maybe compare it would be, but you can, again, jump in if you see it's something different. So if we're at $100,000 and, you know, we're up 0.61%, a return of $610, right? But if we drop the portfolio to $50,000 starting capital, that doubles our return, and that keeps that return amount the same. So we're up 1.22% if the account was 50,000. And then really, I think the account should be roughly like 25 to 30,000. And if it is, we can see we've actually, you know, made almost 2.5% currently on the portfolio. You know, obviously there's still a handful of trades open, so this could fluctuate up and it could also fluctuate down. But at least it gives, I think, a more relative, you know, value versus percentage increase based on, you know, what the portfolio size should be based on those, you know, based on the amount of trades that we're going to have in there. Again, your risk profile is going to be different, you know, from 25,000 or different from 100 or even different from 10. It's going to be comfortable for you. But I just wanted to show some relative, you know, if we used a different type of, you know, type of starting capital amount. Let me pull that back up if I can. So, you know, if we look at positions, I mean, again, we talked about the ones that are still open. Out of the open positions, we have 12, a couple that I just put in recently. But out of the 12 open positions, we can see 1, 2, 3, 4, 5, 6, 7. So 7 of the 12 are actually down money, and then 5 of the 12 are positive. And then again, we've closed 7 of the positions out, you know, for a profit. None, we have not had to exit any yet for the earnings to come about. But again, American Express coming out on, you know, on Friday morning. We're going to have to get out of that trade tomorrow. And then here's all the closed positions that we've had, you know, so far that have turned portfolio. Some of the other portfolios, let me pull them up real quick. I'll close this one out. We have all the estimated positions. We have some of these other confirmed. None of them are really moving as much. If we look at the bearish runners confirmed, you know, there's only one position in there. I think it's Delta, if my memory serves me. Yeah, so we're looking at this Delta position here. We entered in that position on 4/14, so we got a bit of time on there. And basically, we can see we're down a little bit of money on that trade as well. I think Delta might be up a little bit today, but pretty flat for the most part. So all in all, you know, the positions are I mean, the portfolios themselves are kind of running, you know, running fair. The main thing, you know, a lot of these other portfolios are pretty new. The bullish runners and the vol crush, those are pretty new positions. Let me show you the vol crush. The vol crush just come out with a trade the other day, so we can see. You know, I keep a track here. So on 4/18, the Johnson & Johnson trade had come out. So I track that volatility crush trade. And again, as we've talked about before, you know, getting into the volatility crush trade prior to the close of the market and then holding that through the earnings announcement and then getting out that same day because you want to get out of the trade, within that 1 day time frame. And then by doing that, I was able to capitalize a little bit of profit, on the position. So the way the trade was constructed, it was not balanced. So we've seen that with some of these positions as they come over with the pre-alerts, that when, I create these daily alerts via the backtest that we run, we don't have that balanced option in there. So depending on how the strikes are selected, it can skew the width of the iron butterfly a little bit. But nonetheless, I found this trade to be pretty interesting because if you set it up or if you tracked it, the credit that I received was pretty close to the amount of money that I would lose if the stock actually went up. We can see from, my short call, at 180 to my long call at 182.50. The most I can lose on that side is $2.50, and the credit that I received on the trade was pretty close to that, or even a little bit more than that. So it was interesting that the way that it was skewed based on that not being balanced, that it had that trade set up, which was interesting when I set it up. But either way, got all the trade yesterday at the close, and then this is it came out to be a bit profitable. Sudhir had mentioned he wasn't going to be able to be on the call today, but he's going to listen to the recording. He said he is actually down a little bit of money on the iron butterfly trade. Sorry, Sudhir, for mentioning that if you didn't want me to. But, I wanted him to send me over the details, if he would, of the trade that he put on, because I'm assuming it's going to be a little bit different from the trade setup that came out in the pre-alert. So I wanted to look at that to kind of make some more analysis on it. So, like I mentioned, all in all, the portfolios seem to be, running pretty good, good as it can be expected in this market environment. Any, comments, questions, anybody want to look at any of these portfolios in more detail? All right, no comments or questions. So the main thing that this led me to think about today was, when I traded commodities in the past, I had a lot of customers that were kind of day traders or, swing traders. They would get in and out of the markets pretty quickly. And this market movement that we've had, since the first part of February, or even going back to the first part of the year, it's been pretty choppy. I mean, some of these moves have been fairly long, a big move to the downside, it's taken a week or two. Big move back to the upside, it's taken a couple of weeks, and so on and so forth. So I've seen a lot of people whipsaw themselves in and out of the market and really not know what to do. You hear us talking and kind of having a negative tone with rates going up and things going on, and then you see the news, and some people are a little more bullish, and they're saying the market's going to go up, and then other people are saying it's going to go down. So really easy to get confused on what to do. But I really feel that the way this earnings plan has been playing out thus far, it really seems like it has the ability to kind of keep you focused and keep you in tune with the goal of what you really want to do, and that's not to be super choppy or super whipsaw yourself in and out of these markets. Hold on to some of these positions that we've tested that seem to have worked really well in the past, and it seems like those positions should be fruitful moving forward as well based on those numbers, right? The dynamic of the markets can change, and that can potentially change our positions and how they're working. But as of right now, we get this little downswing in the market, but a big move like we had yesterday, definitely helps these positions substantially and helps us increase that return to the good. And a lot of these positions being the bull put spreads like we've changed them recently, it just seems to really protect you and kind of help capitalize on some of those moves where you're not, buying those long calls that are so far out of the money now that it would never happen. So I think that changed the bull puts and the strategies themselves can really help you stay grounded, if you will, in this environment that we have, as of right now. So, I wanted just to mention that to you because I've seen a lot of people do that in the past, and it's really easy to get confused. And one, you might not do anything, so you're really not making any money, and based on inflation, you're losing money, or you're just getting in and getting out so much that you still don't know what to do, but you think you're doing something, and really you're not. You're really just kind of hurting yourself more so than helping. So I did want to mention that. Any comments, questions on that? Anybody doing that, not really sure what to do, or just getting in and out of certain positions because the market is so, kind of choppy? They're buying it, then they're selling. Anybody doing either of those two?
Shawn, one thing, kind of a follow-on to your iron butterfly, when it's, it's always skewed a little bit unless the closing price is like right at a strike, so that you can get the same width, on each side. So almost everyone's going to have a little bit of bias, a little bit one way or the other. So I tend to look at those when I'm like choosing between, I'm want to do 1 out of 3 that are, possibles or something like that. If I have a bias that's in favor of, that would give me a little edge just because the strikes are not quite centered. I picked the one that, it's like, well, if I'm right, I'll have a little bit more edge. And another thing that you can do it almost it's the same way is to change the widths of your strikes on the butterfly so that one side's a little bit wider than the other toward your bias. And you can use, it's kind of a complicated description there, but the offset from the at the money strike at the close, you can use to, it's almost like a hedge against your bias on the width change of your strikes. And so you can use that to your advantage if you're confident on the particular thing you've been following and it happens to be on one of the portfolio, it's a candidate for that group, whether it's a vol crush or a vol rise kind of thing. That I think can think about that. That can help you too, in my opinion, is to it makes you think about your prediction on being a little bit biased one way or the other. And if it just the more you actually pick a little bit of a bias and you can get better at it, the better you're getting. It's kind of like the mantra of the more you trade, the more decisions you make, the better you get at making decisions. So if I force myself into a little tiny bit of bias on some of these trade strategies, when it's like, well, pick the strikes, is it 5 cents or 30 cents away from the at the money strike one way or the other, and it will that provides a little bit of bias. I think that can improve your confidence, if nothing else, just by watching how that turns out. Just watch the way your trades turn out when you're following the strategies, and you get a little bit one way or the other by choosing the strikes. And I don't know, I sort of rambled there, but you follow what I'm saying about the biasing part, even using.
I do.
This. Okay, thanks. I didn't know whether I was poorly or what, so sorry about that.
No, I do. And I think, and Josh, Joe, and Ashok and myself talked about that, or maybe just Josh and Joe and myself this morning, right, is that when you're doing these iron butterflies and you see it's a little bit skewed on the pre-alert, that's just the way that it's set up. And Johnson & Johnson, this one that I have here on the screen, happens to be one of those that the strike selection that are available, the strikes that are available are $2.50 between each other. So that really can skew it, right? If you're talking about a stock that's at 177.66, well, do you go down to the 177.50 or do you go up to the 180, right? So that's where a little bit of that, like you say, that personal bias might come into play, and unfortunately that's just kind of how it has to be on some of these iron butterfly trades, especially when you have ones that are $2.50 wide like this one, or there's some that are $5 wide and there's some that are $10 wide. So then you really, making that judgment call could skew the trade substantially. So does everybody understand what Dave is saying? And the Johnson & Johnson is a perfect example, because the way that the pre-alerts are set up is that here's the snippet that I take of when I actually do the trade. So the way the pre-alert is set up is it's set up to basically sell the options that are 0.1% above the market. So, that's just the next strike available. So if the market, or if the particular Johnson & Johnson, as we see on here, closed at 177.66, even though there's an option available at 177.50, we said to say, buy one or sell, the ones that are 0.1% above. So now it's going to go all the way from 177.66 to 180. So then you can see on this dynamic here, it's selling the call and selling the put at 180 when the market or the stock is, is almost $2.50 lower. So that's where, I think, you could use that judgment if you wanted to do the 177.50, and that would skew the trade a little bit, obviously. And then the stock did go up. So selling the 180s versus the 177.50, went to my benefit by doing this. but really that's just, you know, I hate to say the luck of the draw, but really that just is the luck of the draw. And then when you're looking at the wings are looking at the expected move from the current price of the stock as well. So it's looking at 177.50 when it's using the expected move. And so since it had to jump up, you know, almost 250 cents to grab the 180, now it only has to jump up another 250 to grab, you know, one that's, you know, roughly the expected move from the current market price. I hope that makes sense. In my mind, it does. But so that's why this one was a great example to kind of show, you know, how that one can be a little bit skewed. But what I thought was cool about this one is, like I said, it was skewed, but I think the credit that was received on the trade was like maybe $3 and change. And the most you can lose to the upside on this one is $2.50. So if the stock went up, hey, you're still sitting in a pretty good spot to where, you know, you're probably going to be profitable. And it was, even with the stock up yesterday, you know, at the close. So I just wanted to show you guys that. But Dave's right. You know, I feel that if you really want to make some of those adjustments based on your personal bias on the particular stock, you can adjust these trades, you know, in a decent amount of ways. But as I said before, just make sure you get in there and test it and back test it, and just make sure those results are the same, or those results are going to be, you know, applicable to what you're looking to get out of the trade. And if you're not sure, then throw it in that virtual portfolio and test it and let it see, you know, see what the results are going to be. You're always going to have that trade again, you know, possibly the next quarter. So don't worry about missing the trade if you want to test it. Test it, make sure you're comfortable doing it, make sure you're comfortable in all scenarios of that particular stock movement, and then be prepared for the next time to go around. Don't jump into it if you're not completely certain of you know, where your risks are and where your profit potential are, because that's where you can make a mistake and really cause some psychological problems for the trades you put on next time. Any other comments or questions regarding the earnings plan?
Shawn, did you put out an earnings email for this afternoon yet? I don't think I saw anything. Were you going to do
No,
Tesla?
not yet.
Oh,
Excuse me?
were you doing Tesla or not?
I don't think Tesla. I think Tesla's not on the list anymore for the vol crush. So I'm personally not going to do it. That's just for personal reasons.
Okay.
And no specific reason. I think you can probably come up with some pretty good. I mean, we always know Tesla and the Netflixes. You can always come up with some pretty good risk to reward ratios on those trades. And Tesla's usually, I mean, Tesla has definitely been one of the better ones that I've found to do that type of trade on. But yeah, you see some like Netflix today and things like that, and it kind of bothers you a little bit, right? It kind of makes me a little more hesitant, I think. You know, I don't think that's right, but it kind of just makes me feel like, man, if Musk says the wrong thing or the right thing.
Yeah, I agree.
People are already a little bit nervous. Yeah, people are already a little bit nervous, so that just might make them a little more nervous, right? And if you see that recent rally, right, it was up to 140 yesterday, I think, and now we're down to 985, so it's down almost 4% today, down $40. But as a whole, I do like that trade as typically as a fall crush trade. That one is definitely, I think, one of the better ones, right? I'm just a little concerned with what happened today.
Yeah, I understand. I agree. Thank you.
Yeah, no worries. So yeah, other than that, you know, we got a couple more minutes. I just want to show one thing. I think it was maybe Lee that had mentioned this earlier regarding Josh's trade, regarding Josh's analysis on SPX and SPY. I put that in the virtual portfolio just to kind of show you. I went out, so I'm using last night's close. I did, you know, I think the SPY is pretty flat right now, maybe up 0.25%. But I did kind of what you said, Lee. I think it was Lee, right? Where you're looking to, you know, expiration date for 520. I set it up using the 440 and the 460 and then the 420 as my wings. And we can see the risk to reward is pretty good in my opinion, right? I mean, we're talking about collecting almost a $1,400 profit and risking, you know, about 567. You also want to take into account, though, Josh had those lines up there of the support and resistance, or the channel lines. This doesn't completely cover that, because remember, we're using these wings, but that doesn't necessarily mean that the wings are our break even. If you look here, you can see your break evens are going to be inside, roughly 426 and 454. So you really want the market to stay between 426 and 454 coming to expiration, which again is May 20th. I tried to use those 30 days out there. So, just you can just play with trades like this within the virtual portfolio and see if those trades, those risk to reward scenarios match, what you're looking to do. And if they are, then test them out. Again, test them out or trade them if you want. What I really wanted to see here was I wanted to see this number, probability of profit, pretty interesting, 61% on this particular trade. So, the wings of the trade, the break even, is pretty decent. Probability of profit, 61%. And I really like that risk to reward. So if I really think that channel is going to stay, I could, this is a good risk to reward. Now, if you see that channel happening again, 2 months ago or 6 months ago, go back, use the time machine, go back in time and try to do a similar type of trade and see how did that trade play out if the market did stay in that channel, or if the SPY jumped up or if it sold off, how did that affect this trade? Did it affect it in a big way to where, then I'm not going to be comfortable with it? And if so, maybe that's not the trade for you. But going into this trade, you're risking $567. So, that's again a pretty good risk to reward. So I just wanted to show you that. You can set it up. There's other things you can do. Sudhir talked about those long put butterfly spreads. Buying those or the long call butterflies, you can use those. So there's a bunch of cool different designs of trades that you can use based on that channel, and then really just coming in here and setting them up and say, okay, well, what's the risk look like? What's the profit look like? What are my break evens? And just match those up. This tool here, I think is pretty awesome for you to be able to get a decent picture on, where do you make money? Where do you lose money? And gives you your max risk and your max profit right off the bat as well. So really cool tool that you can use based on where you think the market might be here or what you think the market's doing. So any questions, Lee, on that?
No, Shawn, but I appreciate very much you going through this. It does give you a great picture of what it could be.
Yeah, it shows you really quick. I can figure it out by hand, and I'm sure most people on the call can figure these out by hand, but it takes a bit of time, right? You got to sit there and run through the numbers. But to be able to have one screen up of the chart and then have this up and just be able to play with the expirations and play with the strikes and see it, graphically on one screen and see the numbers on the other, just helps me get a good picture of like, okay, this is great, and when I see, so yeah, and I even did you could even do some where you're, selling, you're selling the spreads, and like we've talked about selling the call spreads above it or selling the put spreads. You can just play with a bunch of different cool things like that and pretty quickly see, where are you going to get the best bang for your buck based on where you think the market's going to be and where the break evens are and things like that. So,
right. Thank you very much.
Hey, Shawn,
yeah, no worries. And I think,
what was your
Go ahead.
decision at going at 440? I mean, the market closed at 430, 445. So you're thinking it's going to go down.
Yeah, that's a great point, because I'm doing these, and really when you're doing these, you're selling this call, this 440 call. So you really are selling a call that's in the money by 5 points. Now, we have 30 days on there, so typically being assigned of that, the assignment risk is going to be quite low, at this point of the game, right? 30 days out. But I just did the 440 based on when Josh said Josh just pointed the 440 number out when he was looking at the chart. So I just plugged in 440 real quick. But you're exactly right. Markets at, let's say it's at 445 or 446, you would just make the appropriate adjustments here, and you could probably get a better, if you went 445 and then 445 and then go up 5 points, right? And then go up 5 points. So yeah, that would probably be a more accurate representation of, the market's really at 446 right now, but this is a little bit closer, right? So you can see now we're getting a little bit less than 1 to 2 on our risk to reward, but still good, in my opinion. Now our upside is getting close to that 460 range on the break even, but we did jump up the lower break even. So that's the only reason I picked 440 was Josh had mentioned that. No particular reason. I just did the 440s and 460 and 420 because I think that's the numbers or approximate numbers he had up.
Okay, and the other question is, why go so far out on the expiration?
Yeah, and then Lee was just talking about 30 days out. I think he said a month when he said his example, so I just used 30 days out. No particular reason on that either.
Okay, because, with the vol to crush, you tend to go like that Friday or the following Friday. So with this type of butterfly, I would think the same thing. You either go 1 week out and that's it.
Yeah. Yeah, I agree. I think some of these, I think I'd want to have a little bit less time, on the trades and maybe see what that volatility is. If the volatility spiked up on which month does it seem like the volatility is a little higher on? Probably closer on the near expirations, not month expirations, but probably near weekly expirations. Without looking at them, I would assume so. But yeah, that's just some of the other analysis that you'd want to look at, like how long do you think you want to be in this trade? And like you said, if you look at these recent moves in the market from the up to down, I think it's lasted 2 weeks maybe. It seemed like we had that big sell-off at the beginning of the year that was about 2 weeks in time, and that little rally was about a week and a half, and then that sell-off was like 2 weeks. So yeah, I could see you going out like 2 weeks to kind of capitalize on something like that, right? But that's going to be a judgment call. Again, I would try to find similar setups in the market, looking at a chart and see if I could find similar setups of similar time frames and try to back test it somehow. Try to come up with a creative way to back test the idea and then just see if the results are in line with what you think, right? It's going to be kind of you're going to be setting yourself up, I think, because the window of the range that we're talking about is pretty specific right now. So it might be hard to replicate that in the past, but this just gives you an idea of like, hey, I had this thought, let me see what the trades would look like. No really back testing or kind of previous analysis put into this one.
Shawn, it's Jean.
Yeah.
Jean. Just verification from your standpoint. I think the iron butterfly for earnings is on those short-term expirations because of that vol crush. This iron butterfly is not based on an earnings because SPIES doesn't have earnings. And so you could go out farther because you're not looking for a vol crush. Isn't that correct? I mean,
yeah,
I'm thinking that's why you would take a longer expiration date unless you were looking at an earnings trade, and then you'd want that few days or a week.
Yeah, and that seems fair. That seems like a fair analysis. And I would probably go back one day, like I'd probably go back to Monday and say, okay, let me put this trade on Monday. And then I would try to see what did yesterday do to this trade, right? Maybe on Monday I was going to get, I don't know, let's say Monday I got a $1,500 credit. And then yesterday it dropped it down. So I lost $200 in a day. And I could say, oh, okay, I'm not comfortable losing that in a day, right? And then I would be able to see, okay, what does a big move in the market and how does that affect this trade? So yeah, you're right. I mean, you're not, that vol crush, we're really looking to just get that increase in volatility and then that crush based off of the earnings announcement and the SPY, you're not really going to have that type of impact. I mean, I think a good announcement or a bad announcement in one of the companies within the SPY will definitely affect it, like we saw, possibly with the NASDAQ today and Netflix, but not to the big of extent as it would if it was just a single issue, I don't think, right? So that seems like a fair analysis as well.
Okay, thanks.
Is that good, Russ, or is that fair?
Yeah, I mean,
Sort
in
of.
reality, you probably could do a butterfly on all the earnings trades when it reaches right around earnings because you anticipate it to go up.
Well, you're anticipating, that the vol crush, you're wanting that vol crush to happen. So on most of those trades, I mean, on some of them, it's just not, the volatility is not increased as much to make it worth that type of risk, right? But some of them, like the Teslas, that volatility does get pushed in there so high that crush is inevitable going to happen. And when it does, it takes a big bite out of those options. Some of them, it doesn't, it's not as impactful, I guess, or maybe the volatility just doesn't increase as much. But yeah, this one wasn't really based on this one's not really based on, like Gene said, this one's not really based, I don't think, on, volatility or really anything like that. It's just like, how can I trade, this channel in the market, to the best ability with the least amount of risk, I think, or with limited risk. And really this trade design is just trying to show you, try to just get creative and plug these numbers in. I mean, you can always find some pretty cool trades. Just make sure, the risk is kind of what you're comfortable with and the profit is too. And then again, if there's a way to then reverse engineer it and figure out, I found the trade that I like this trade here. Now, how can I replicate it by using maybe some entry points within the market to see if I can backtest it? And if you can, that just kind of helps add validity to the trade, in my opinion. So multiple ways, I think, to use the platform to you just got to get creative sometimes and try to figure these things out.
Shawn,
Yeah.
Jean again. On the probability of profit there, in this case, it was 43%. On another one you showed it was something like 60. Do you have a range of that one should be looking at? I mean, you wouldn't want it to fall below what percentage rate?
I don't have a specific, I'm sorry. Yeah, I don't have a specific number that I look at. I just remember those long calls being really low, right? I think some of those long calls that we used to do were, sub 20%, really low. So then when you get into some of these where it's like a 50-50, I mean, a 50-50, you still want it to be better than that, I think, in your favor. But, a 20% chance to a 50% chance is a huge difference, especially in some of these, in my opinion. So, I like any of them now that are above that 50%, but that's just a personal preference, no particular reason.
But this one's
Joe
only
or Josh,
43.
oh.
This one's only 43.80. So you're not really looking at that in this case because you were looking more at the max profit and max risk, I think, right?
Yeah. And I just adjusted these strikes because we were talking about getting them more relative to where the market is right now, and that probability might be relative to, obviously the credit's a little bit lower than, so the credit's a little bit lower than what it was on that previous trade. So that might drop that probability of profit down a little bit. But, we can look at that lower range like Josh was talking about was maybe around 420. So we're getting further away from that 420 range, even though we're getting closer to the 460. So that could adjust that probability of profit a little bit as well.
Okay.
Yeah.
Right,
but yeah, 50% seems pretty cool, right? Because you're like, all right, well, I can take that. I mean, 50%, I'm going up or going down. I mean, I want it to be better than that, but that's just really, again, a personal preference. Josh or Joe, have you used that too often, that probability of profit? I just remember the long calls being so low and some of these being just much better.
I really haven't, Josh or Shawn.
Yeah, no worries. And
I'll glance at it, but I think it's just like a calculation, like a statistical calculation. So
yeah,
I'll glance at it.
And and I just remember Gene just really seeing those long calls be sub 20, and then some of these be just much better. And you're like, all right, well, that seems pretty relevant in this particular trade, right? So sorry, I have to be a little vague on that one.
Kind of reminds me of like looking at the implied volatility when you're thinking of buying or selling, right?
Right.
You want it to be at least 50% sometimes.
Yeah, I just want it to be a little bit higher,
Yeah, okay. All right, thanks.
Oh, no worries. Yeah, that's all I had. I just want to show you guys this. I think it's great. When you have an idea of a trade and you're like, well, could I do that in this particular environment? Plug the trade into the VP and see what it shows you. If it shows you a good risk to reward and it's something you want to, explore further, then see if you can use an entry point to backtest it. And if you can, great. If you can't, it might be something that just might not be as easy to lay backtested. Doesn't mean it's not going to be a good trade. It's just a little hard to kind of get those specific numbers in place if you can't backtest it, in my opinion. But doesn't mean it's not a good trade, especially in some of the environments we're in. But yeah, that's all I had. I just want to show you guys the virtual portfolio. So those trades seem to be running pretty good, even though we're getting this little bit of a, this downturn, this kind of gradually sell off in the market, if you will. Some of these spike ups like we had yesterday, it's just, really key on these trades, really helping these trades out substantially. So, next week, Ashok's going to be here, like they had mentioned. I'll have some more updates to show you guys on the trades, and hopefully the trend continues within the virtual portfolio. Any questions or comments, always feel free to shoot me an email or give me a call, and I'll be more than happy to help you out. So thanks for your time, everybody. I appreciate it. That's it. Josh, back to you.
Yeah, thanks, Shawn. Thanks everyone for attending. Next week we'll have the show, so please tune in. But thanks for coming. Have a great day.
Thank you.
See you guys. Have a good